For this session, we are to talk about your provisions and contingent liabilities. In talking about your provisions and contingent liabilities under PAS 37, we will talk about the recognition of a provision or contingent liability and when do we need to recognize it or when do we start to place them in our financial statements, including the measurement thereof, particularly the initial and the subsequent measurement of your provisions and contingent liabilities. Let's start first, of course, with defining what is a provision. A provision is an existing liability of uncertain timing or uncertain amount. So what makes your provisions differ among other types of liabilities? First is the uncertainty of timing, and next is the uncertainty of amount. When we talk about uncertainty of timing, this talks about when you will pay or when will you settle that obligation. So we look whether it will occur and when will it occur. Unlike other types of liabilities, when we're in there is a specific date as to the settlement of that liability, such as your notes payable, your loans payable. Those types of liabilities normally has a settlement date or there is a maturity date. Hence, the occurrence of those liabilities are known. However, here in your provision, one characteristic is that it is of uncertain timing. Why is it again uncertain timing? Because we do not know when will it occur. However, it is considered as an existing liability. Next, as to the uncertainty of amount. So it can either be uncertain timing as to the occurrence, uncertain amount as to the amount you will pay out of your liability. Why? Because your provisions does not have a fixed amount as to the settlement value. Unlike your other liabilities wherein we have here a fixed amount to settle. But in a provision, the amount is uncertain. Why is it uncertain? Because normally we only estimate this type of liabilities. That's why I said a while back, your estimated liabilities is an item of your provisions because normally we just estimate the amount of our liability. The provisions, their nature is still a liability. However, it is uncertain as to timing because we need to know the occurrence or when will it occur, and then it has a certain amount because we only estimate its value. So either uncertain timing or uncertain amount. Take note of the conjunction used. We use the conjunction or uncertain amount. So when do you use a provision? You use a provision for every separate obligating event. So remember before in the definition of a liability, we need a past event to create a liability or an obligation. In this case, your provisions, we must first have a past event or also known as your obligating event before we can recognize a liability, which we know as a provision. Okay? So take note, provision, uncertain timing, or uncertain amount. So whatever concepts we learned as to the recognition of a liability still applies to a provision, except that in this type of a liability, we have uh, uncertain amount or uncertain timing. We go now to your recognition. So when do we recognize your provisions? We recognize your provisions once you have a present obligation. So when we talk about present obligation, you have the duty. You have the duty to settle that particular obligation based on an obligating event. Take note, past event creates now an obligating event which gives rise to a liability. Next, it is probable. So when we talk about probability, again, we're talking about the timing. Normally, probability is defined as your outflow of economic benefits. Although there will always be an outflow of economic benefit, Here, the probability timing is what we discuss on a particular profession. So when we talk about probability as a form of timing, the occurrence must be more than the non-occurrence. Okay? The possibility that it can occur should be more than the possibility that it will not occur. So it must be more likely than not to occur. So, mas okay na meron yang liability na yan, na mangyayari yung liability na yan, kesa hindi siya mangyari. Okay? More likely than not. So the occurrence must be more than the non-occurrence of that liability. Further, it must be measurable. So when we talk about measurable, we talk about your best estimate. Later, we will talk about how do we measure a provision, particularly its initial and its subsequent measurement. Okay? So when do we recognize? Of course, once it meets the definition of a provision, but particularly once it is a present obligation and there is a probability and it is measured reliably. Let's proceed now to the measurement of a provision. As a general rule, we initially measure your provision at its best estimate. So whatever is the best estimate provision or what is the best estimate that is provided under your problem, that is your amount of provision. So pag sinabi na dun sa problem, the best estimate of the liability is 3 million pesos. If the problem states that the best estimate is 3 million pesos, that is our measurement. But what if we are given a continuous range? So what is your continuous range? This is the range of possibilities, meaning we have a higher amount and a lower amount. So for example, your possibilities are from 3 million up to 6 million. So that is a continuous range. You have a higher amount and we have a lower amount. If that is a continuous range, how do we measure it? We get the midpoint of the range. To get for the midpoint of the range, 3 million plus 6 million, we divide it to 2. So 4.5 million pesos. Okay? So continuous range, get the midpoint of the range. Now, what if you are given large population of items? So if you are given large population of items, meaning you are given different outcomes or possible outcomes out of the provision. So if there are different outcomes, how do we measure it? We measure it by weighting it or statistical method. So what is weighting or statistical method? So under this method, we get first the weight of a particular outcome. So weight of the outcome multiplied by the outcome. So for example, if that is a large population of items that have different outcomes, as we have said. So let's say outcome one is 300,000. Outcome two is 5 million. Outcome 3 is 8 million. Outcome 4 is 10 million. And then we get first the probability of that particular outcome. So let's say outcome 1, the probability is 5%. Outcome 2, the probability is 30%. Outcome 3, the possibility is 45%. And then we have your outcome for the probability is 20%. So if ever we are to compute for the value of our provision using your large population of items, we must only weight it based on a particular outcome. So let's compute outcome 1, that is 300,000 times 5%. Outcome 2, 5 million times 30%. Outcome 3, 8 million times 45%, and outcome for 10 million times 20%. And then you get just the total. So the total is 7,115,000. So this will be our value of provision. Okay, general rule. How do we measure your provision? We get the best estimate. And what is the best estimate? The best estimate is the amount that best results to the value or measurement of our profession. So if the problem tells you that the best estimate is 3 million, then the best estimate is 3 million. Now, what if there's no best estimate? How will you measure it? So if there's no best estimate and there is a continuous range, what is the continuous range again? It is a range of outcomes or possibilities which provides for the higher and lower amount. So in our example, our lower amount is 3 million, our higher amount is 6 million. We just get the midpoint of the range. So the midpoint is 4.5 million. Next, what if we have large population of items? If that is a large population of items, it means we are given different outcomes. And out of the different outcomes, we get the weight of each outcome. So for example, here, we have outcome 1, outcome 2, outcome 3, and outcome 4. 300, 5 million, 8 million, and 10 million. We multiply it to the percentage or to its weight to get for the value of our profession. Note, if needed, the present value is based on pre-tax rate. Okay, so what is this particular note? Normally, we said that we have an uncertain timing here. Since it is uncertain timing, generally, we do not know when it will be settled. However, as a nature of a liability, since it is a liability, it should be settled on a future date. Since it will be settled on a future date and it requires the measurement of a present value, you should take the pre-tax rate. If it is measured at a present value, you should get the pre-tax rate. Okay, this is a reminder that you will use the pre-tax rate. Why? Because if you have remember, or if you do remember, in your previous lessons, that in case you are to measure a present value, how do you measure the present value? Using the market rate or the discount rate. However, it is now specifically provided under the standard that once you measure the present value of a particular provision, you measure it using the pre-tax rate. So you will not measure it using discount rate or market rate, but under PAS 37, was it what is it? It is your pre-tax rate. The present value should be computed using the pre-tax rate. Okay? So how do you measure best estimate, continuous range, or large population of items? And if there is a present value, you use the pre-tax rate. Reimbursements. So reimbursement is still part of our initial measurement. Why? Because normally, if that is a provision, there is a possibility that you reimburse a certain amount of out of that provision. So let's have an example. Okay. So say for example, you are in a lawsuit. That lawsuit pertains to an infringement. Okay, so infringement lawsuit. Now, under your reimbursement, let's say that particular risk or that particular lawsuit is insured. So, naka-insurance siya. So, aside from the lawsuit, you have an insurance, meaning if ever you lose on that lawsuit case, you have an insurance which can insure that lawsuit case. Okay. What is the nature of that insurance? That insurance is in the form of a reimbursement. So you will pay on a particular loss out of the lawsuit case, but at the same time, you have a possible reimbursement out of that case or out of that loss. The problem now is how should we measure that particular loss? To measure the particular loss, we follow provisions because here in the loss on your lawsuit, that is considered as a provision on a future liability or on a future amount to be settled, but the reimbursement should be measured separately. So we have two items here already, the provision and the reimbursement. The provision is considered a liability, but the reimbursement is considered as an asset. So how do we recognize that? Take note, under the standard, you should recognize it separately and you do not net it against the provision. So for example, our provision for the possible loss on the infringement case is 3 million pesos. Now, if we have a reimbursement of 200,000 pesos, how do we recognize them? We will not report it as 2.8 million, but we will recognize them separately. How? One for the liability for the provision and the reimbursement as an asset. Okay? So you recognize it separately. You will not net it against the provision. How do we recognize it or when do we recognize it? You will only recognize this one if it is virtually certain, meaning the reimbursement as an asset will be recognized only when it is virtually certain. Why? Remember, if that is a liability, we only need the probable. But now, once it is reimbursement, an asset, what do we need? It must be virtually certain. Why is it that it must be virtually certain? A while back, we have defined probable as more likely than not. Now we have virtually certain. When we say virtually certain, it will really occur. It will really occur. So, if ever, why do we need to recognize only the reimbursement when it is virtually certain? Because of your conservatism concept. So what does your conservatism concept provides you again? That it is better to understate your asset than overstate it, or it is better to overstate your liability than understate it. Here, for your liability, it would be easier for you to recognize because you only need to meet probability, more likely than not. It does not tell that it will really occur. However, in your asset here, it must be virtually certain, meaning it must really occur. So a while back, probable, it can occur. In your virtually certain, it will occur. There is certainty. There is certainty as to your virtually certain, while in your probable, there's not. Why again? Because of the principle of conservatism, which states that it would be better to overstate your liability than understate it, or better understate your asset than overstate it. So as you can see, since mas mababa yung level ng pag-recognize ng liability, there is a chance that you can overstate your liability. But in your asset, there is a higher level as to the recognition, which is virtually certain. Then there is now a chance that you will not recognize that. So it is better to understate it now because you will not recognize it based on virtually certain recognition, while in your probable, you can easily recognize because of the probable recognition. Okay? So the recognition of your reimbursement as an asset here is only when it is virtually certain. Take note, you account for it separately. Now we go to your measurement of your reimbursement. What amount should we place as an amount of your reimbursement? So the amount must not be the greater amount than the amount of your provision. So it must be at the present value also. Take note here, guys, in your reimbursement, since you will only reimburse your loss, your reimbursement must not be greater than your loss. Okay? Because if your reimbursement is greater than your loss, then you already have a gain. That cannot be. Your reimbursement must be at most with your loss only, or at least a portion of your loss, but not more than your loss. So your provision is considered your loss, right? So we have, let's say, 3 million loss. Now, as a reimbursement, you cannot have more than that amount of loss. It should be at least equal to that amount or less than that amount. Okay? So take note, when you measure now your reimbursement, it must not be greater. So it can be equal or it can be less than. Finally, expenses incurred in settling the provision may be netted. So this one happens already when you already settle the provision. So at the time of settlement. So at the time of recognition, what did we say? Separately, do not net. At the time of settlement, you can net it. Whatever is the expenses in settling the provision, you can net it. Okay? You can net it on your reimbursement. But as to your initial recognition, cannot be. Okay, reimbursement, you should separately recognize it with your liability. You recognize it only when it is virtually certain, pursuant to the conservatism principle. When you try to measure it, it must not be greater than the amount of the provision. It should only be equal to the amount of your loss or your provision, or it must be less than by it. Why? Why do I say that provision is a loss? Because generally, your entry in a provision, your entry on a provision is a debit to a loss and a credit to a provision. Okay? So whenever there is a provision, you have a loss. That's why I tell you that there is a loss when there is a provision. Okay? So it must not be greater or it must be equal or less than your amount of loss. That is as to reimbursements. Okay? So we're done now discussing your initial measurement. Let's proceed now to your subsequent measurement. Remember, we recognize your provision. Provision is recognized once there is a probability that particular loss will occur. Okay, so we base it on the occurrence. So in your subsequent measurement, we look whether it will still occur or it will not occur already. So, di ba? Initial measurement, we only need to look whether it is probable or not. When we say it is probable, it is more likely than not to occur. So if we can say that it is more likely to occur, if we can say it is more likely to occur, then it is still probable. If not, it is not already probable. So if it's probable, the adjustment is presented in profit or loss. If it is probable, the adjustment is presented in profit or loss. And you carry out the effects of discounting. So what is this adjustment in is presented in profit or loss? This happens, guys, if your initial estimate differs with your subsequent estimate. So for example, our initial estimate a while back is 3 million. And then subsequently, our new estimate is 4 million pesos. So how do we treat that? It is presented in profit or loss. If the liability will increase, the loss will increase. If the liability will decrease, you have a gain. So in our example, initially we have 3 million, now it's 4 million. Increase or decrease? There is an increase. The increase of 1 million will be treated as a loss. So we debit a loss of 1 million, we credit a provision on the particular liability, 1 million pesos. But what if our initial amount is 3 million and then our subsequent is only 2.5 million? So the liability decrease. How much is the decrease? 500,000. So you debit the provision, 500,000, and then you recognize a gain amounting to 500,000 pesos. Okay? So here in your adjustment, you just need to know whether the estimate change. By looking into your estimate change, the liability may increase or decrease. If the liability increased, we have a loss. If the liability will decrease, we have a gain. Further, we said that there might be a measurement using present value. If you measured it using present value, you carry out the effects of discounting. Normally, by debiting interest expense and by crediting a liability. Okay? Interest expense and crediting a liability. That if it is probable. But what if it is not probable? If it's not probable, you will reverse it. So how do we reverse it? You reverse it and whatever is the amount of reversal that is presented in profit or loss. So initially, you say it is probable, meaning it will occur. However, subsequently, you knew that it is not already probable, meaning it will not occur. So how do we compute for it or how do we treat it? We reverse it. How do we reverse it? You present in profit or loss. So again, initially, let's say it is probable for 3 million pesos. And then subsequently, you learn that it is not already probable. If that is not already probable, you remove the amount of your provision. So initially it is 3 million. And then we credit the amount to the profit or loss as the gain. Okay? So if not probable, the amount of provision is treated as gain. Okay? So again, in your subsequent measurement for your provision, you look whether that provision is still probable or not. If it's still probable, you adjust it for any change in estimate. If not probable, you reverse it, and whatever is the amount of provision, that is the amount of your gain. Okay? Now we're done discussing your recognition and measurement. We go now to your specific provisions discussed under your standard. So what are the specific provisions is that was said in your standard? First, you have your future operating losses. Then we also have your onerous contract and the restructuring. So we have three: future operating losses, onerous, and your restructuring. We start first with your future operating losses. So how do we recognize and how will we measure it? So since it is a future operating loss, it is future operating loss, meaning it is not a past event. Remember, we need a past event which creates the liability. However, in this problem, we do not have a past event. Since there is no past event, it is considered not a liability. So what is the recognition? We will not recognize it. Why? Because it does not satisfy the definition of a liability. Next, as to measurement. Should we measure it? We will not also measure it because initially we did not recognize it. Of course, you should not measure it. Once you do not recognize an item, you should not measure that item. Okay? So here, future operating losses, it being not a past event, which is a necessary characteristic of your liability, then it should not be recognized. Future operating losses is not considered as a provision. Next, onerous contract. What is an onerous contract? It is a contract in which there is a consideration given and you need to perform your end as to that particular consideration or agreement or contract. So here we have an onerous contract. Okay. So we have a contract. Out of the contract, it creates an obligation, of course. Okay. Once there is a contract, it creates an obligation. Once there is an obligation, it depends on when will you make that obligation or not. So meaning, once there is a signing of a contract, we have already an obligation or a liability. At the time of the signing of the contract, there is already an obligation or a liability. So assuming that obligation is to be done on a future date. So the performance is on a future date, but take note because of the contract, you have already a liability. Since you have already a liability, you will recognize it. Your problem is your measurement. Take note, nag-entry ka sa isang kontrata at yung kontrata na yan, most probably gagawin mo sa ibang araw or on a future date. Ngayon, since gagawin mo pa siya on a future date, how should we measure it? Sabi ng standard, we should measure it using the least cost of exiting from the contract. What is that least cost of exiting in the contract? So since you have here a contract, you will either fulfill it or you will not perform it. Okay? So you will either fulfill it or you will perform the contract or you will not perform it. So if you will fulfill it, we have your cost of performance or cost of fulfillment. Okay? Cost of fulfillment or cost of performance. If you will not perform it, you have here your different breach or damages or penalty. Okay. So under the standard, once you will not perform it, you will have a breach or damage. Once you perform it, you have your fulfillment or performance. But what do we mean by the least cost of exiting from the contract? That is the lower between the fulfillment costs, lower between the fulfillment costs, or the penalty. So in our example here, we have a contract. You will either fulfill it, let's say the fulfillment is 3 million pesos, or you will not perform it, let's say you will pay 2 million pesos as damages. So whichever is lower. So what is the least cost of exiting from the contract? Our answer is 2 million pesos. Okay? So you will recognize the onerous contract and the measurement is based on the lower between the fulfillment cost or the penalty or damages. So in this case, the lower is 2 million pesos. Okay? Onerous contract. Now, take note. First, we had your future operating losses. Future operating loss is considered not recognized. Onerous, recognized. Why? Because your contract creates an obligation or a liability. How should we measure it? Lower between the cost of fulfilling it or the cost of the penalty or breach or damage. Okay? Last one, restructuring. So under your restructuring, you have a plan to restructure your company. So restructuring program is recognized. But there are two requisites. First, there must be a formal plan of restructuring. Second, it creates a valid expectation. What is this valid expectation again? This is your obligating event. What do we call that one? That is your constructive obligation. So your obligation can either be legal or constructive. So this obligation was created due to your valid expectation. Therefore, the obligation or liability arise through your valid expectation. So when do we recognize a restructuring? Once there is a formal plan or a valid expectation. How do we measure it? We measure your restructuring using your direct costs of restructuring. We measure it using the direct cost of your restructuring. The question is, are all direct costs included? The question is, are all direct costs included? The answer to that is that not all direct costs, not all direct costs are included. So what are these direct costs that are not included? So the following are the direct costs that are not included. First, the retaining, cost of retaining or relocating continuing staff. Number two, we have your marketing or advertising costs. Number three, your investments in new system or distribution network. Okay. As a rule, how do we measure your restructuring provision? Using the direct costs. What are the direct costs not included? First, costs of retaining or relocating continuing staff, marketing and advertising, investing in new system or distribution network. So past 37 excludes that expenditures as part of your restructuring provision. So when we talk about your direct costs again, these are your costs necessary for restructuring, except the three items. Cost of retaining or relocating, marketing and advertising, investment in new system or distribution network. Okay, so we're done with provisions. Under provisions, we recognize them, uncertain timing or uncertain amount. How do we recognize them? Once it is probable, measurable, or it results from a past event. And then, how do we measure it? We measure it using your best estimate, continuous range, or large population of items. Next, what if we have specific provisions? Those specific provisions should be either recognized or measured. So of the three, we have two that is recognized. That is your rate structuring together with your onerous contract, while your operating losses is not recognized. Further, initial measurement, we have your reimbursements. We said that your reimbursements are not netted. It will be recognized separately as an asset once it is virtually certain. Next, we talk about your subsequent measurement as to whether it is still probable or not. We go now to your contingency. What is a contingent liability? A contingent liability is a possible obligation. So unlike your provision, take note a while back we said that provision is probable. Contingency is a possible obligation. So probable pa rin ang ating provision although uncertain ang timing or amount. Further, a contingent liability is not recognized because it is not probable. Kaya nga, it is only possible. It is only possible. So what are the rules then? So what are the rules on your provisions and contingent liability? Once it is probable and measurable, it is considered a provision wherein you accrue and disclose. If it is probable but not measurable, you will only disclose. It is considered as contingency. Next, if it's only possible, whether or not measurable, you only disclose. And once it is remote, whether or not measurable, you ignore. Okay, so the rules, once it is probable and you can measure it, you accrue and disclose. Once it is probable but not measurable, you disclose. Once it is reasonably possible, whether or not measurable, you disclose. Once it is remote, whether or not measurable, you ignore. So when we talk about your contingent liability, we are talking about your loss contingency. Diba sabi natin kanina, once there is a loss, we equate that to a provision. But what if it is only probable but not measurable? Disclose. Reasonably possible, whether or not measurable, disclose. Remote, ignore. Okay? Next, gain contingencies. What are the gain contingencies that we discuss? One gain contingency that we discuss is a reimbursement. Okay. So what did we say? Once you have a gain contingency, when do we recognize it? Only when it is virtually certain and measurable. You accrue and disclose. Take note, for a gain contingency, we will only recognize that gain once it is virtually certain and measurable. Once it is virtually certain but not measurable, disclose. Once it is probable, whether or not measurable, disclose. Whether reasonably possible or remote, ignore. Okay, so the rule, virtually certain, accrue and disclose. Virtually certain, not measurable, disclose. Probable, disclose. Possible or remote, ignore. Okay, so those are the rules for your loss and gain contingencies. Take note, for loss contingencies, we only need probable, while on gain contingency, we need a virtually certain likelihood. Why again? Because of the conservatism principle. Let's try and answer these examples. So assume the following independent cases. These are loss contingencies. So let's have a review on our loss contingencies. If it is probable and measurable, accrue and disclose. Probable but not measurable, disclose. Possible, measurable or not, disclose. Remote, measurable or not, ignore. Okay, let's have an example. Number one. Dwayne Company legal counsel is convinced that the likelihood of losing the case is losing, okay? So loss yan. Losing the case is probable. The potential amount is 2.3. So it is probable, at the same time measurable. Therefore, accrue and disclose. Number two, Dwayne Company's legal counsel estimates that the infringement case may result in a loss of 2 million, but likelihood is remote. So it is remote but measurable. Remote, whether or not measurable, what is the treatment? You ignore. Number three, Dwayne Company's legal counsel estimates that the infringement case may result in a loss of 2.4 million, but it is only reasonably possible. So possible, measurable. Possible, measurable, what is the treatment? You disclose. Next, Dwayne's legal counsel is convinced that the likelihood of the case is probable, so it is probable. However, the amount is undeterminable, so it is probable. However, it is not measurable. Probable, not measurable. What is the treatment? You only disclose. Number five, Dwayne Company's legal counsel is convinced that the likelihood of losing the case is probable. The potential amount of the loss based on reliable evidences would be as follows. So it is also probable and measurable. Accrue and disclose. What do we call this number five item as to measurement? That is your large population of items. So how do we measure it? Using a statistical method or weighting. So first, we have here 1.6 million multiplied by 50%. And then we have 2 million, 20% yung 1.6. And then 2 million times 50%. And then we have here 30% for 2.4 million. 2.4 million times 30%. Okay? So 1.6 times 20. And then 2 million times 50%. And then 2.4 million times 30%. So we have 2,040,000. Okay? So number five, our answer is 2,040,000 as to measurable. So both probable and measurable, accrue and disclose. Number six, Dwayne Company's legal counsel is convinced that the likelihood of losing the case is probable. The potential amount of the loss based on reliable evidences would be around 1.5 to 3 million pesos. So probable and measurable. Therefore, accrue and disclose. What do we call this 1.5 and 3 million? Continuous range. So if that is a continuous range, you get the midpoint. 1.5 plus 3 million. 1.5 plus 3 million divided by 2 will give us 2,250,000. Okay? So loss contingencies, please remember, when will we recognize it? Once it is probable and measurable. When do we ignore it? Once it is remote. Next, we talk about your gain contingency. Okay, gain contingency. Assume the following independent cases. It is virtually certain that Smith would be successful against West for an estimated amount of 1.5. Before we answer our gain contingency, let's have a review. Virtually certain, measurable, accrue, and disclose. Virtually certain, not measurable, disclose. Possible, probable, or possible, whether measurable or not, disclose. Right, probable, whether measurable or not, disclose. Possible or remote, whether measurable or not, ignore. Okay? So again, virtually certain, measurable, accrue and disclose. Virtually certain, not measurable, disclose. Probable, whether or not measurable, disclose. Possible or remote, whether or not measurable, ignore. Okay, the first one. It would be successful. It is virtually certain. And we have an estimated amount. So virtually certain and measurable, accrue and disclose. Number two, it is probable at amount of 1.5. So probable and measurable. Probable or measurable, you will only disclose. Next, it is probable that smooth will be successful. Estimated amount of 1.5. awarded 1 million pesos. So before the financial statement was issued, you are already awarded. So if this is the case, guys, these are events after reporting period. So we will just answer up to this. So it is probable and measurable. Probable and measurable, you only disclose. Next, it is probable, again, at the amount of 1.5. It's still probable and measurable, you disclose. 5, it is reasonably possible, amount of 1.5. Reasonably possible, if it's only possible, and it is measurable, you will ignore. So number 5, ignore. Okay? So we're done with your provisions and contingencies. So just remember the different rules. When do we accrue and when do we disclose it? And how do we measure